it'll be this focus on the opening of harvest elsewhere, and then the timing and the length of the harvest window and how much comes out and into the system at once.
Hi, everybody. Welcome back to the Comstock channel. I'm Marlin Bohling with you. Thrilled to have you with us once again. And we're going to be talking about Wednesday's ag commodity trade in this particular episode. Make sure you like these videos, subscribe to the videos, and share these videos with others so that the word gets spread around a little bit. In fact, I want to remind you, in case you haven't done it already, join a lot of our customers who actually take part in our premium services. Yeah, did you know we had that? Beyond what we're doing on these podcasts here, these, of course, are free of charge to everybody, but we have a premium service where you get much more detailed information. You get every morning, you get a detailed newsletter about market studies and that sort of thing. There is a video included in that morning email that does nothing but talk about market breakdowns and that sort of thing. And our customers that are premium subscribers get to take advantage of all of that. And for the time being, you can too, for just $1. You can get it for a month for $1. See if you like it or not. But the way the markets are nowadays, how can you afford not to? For one little dollar, check it out. For $1, can't beat it. Today, my guest is Joe Camp of Comstock Investments, and he joins us as we analyze what took place on Wednesday. And it looked to me, Joe, it was kind of a yawner in the market, other than maybe the wheat, seeing some slippage in the wheat. Let's start with that one. What do you think was pulling on that?
That is how we'd have to start, because corn and soybeans having an early upside attempt that was foiled by the weakness in wheat futures. You have still the same pressure from abroad, I would say, over this market, where the French prices are heading lower, along with a still very cheap Russian export offer. This is something that we had thought could have started to clear now. These lower international prices, because of smaller crops now being realized for France, a multi-decade low for that crop because of drought, and a crop that in Russia is down as well because of drier weather this last season. But it's the way between all of these old crop exports that are still flowing from these countries in a big way for now, and not allowing much upside for our market.
You know, I keep thinking that we should be at a floor in the wheat market at some point, and I keep guessing wrong. How far can we actually pursue this to the downside? It's kind of amazing.
Yeah, right now we only have below the market some of these very important even money marks, like $5 in particular for Chicago wheat. You know, we're talking about being at lows for the wider grain complex that we haven't seen before since, again, 2019 or 2020, in the lead up to the pandemic and the shift in interest rates. We have to tie these recent lows in a big way, because we think about where the economy's been and all the inflation and the ag market, where it's moved over the last 4 or 5 years. And we could be similarly entering a very new stage for the overall market structure, because of, like 2020, it being an election year, it being the last time that interest rates were being lowered, it being the last time that the dollar index had a long pull to the downside that helped out commodities and grain export prospects for that matter. So a lot of drawing back to these really big values that are below the market, but still below the market and potentially targeted still by the bearish speculators.
Now, are we still under the influence of harvest pressure then in the wheat? Because it seems like it's still ongoing.
It's ongoing and advancing from winter wheat into the spring crop. That being a part of probably the weakness, I would call it, this week as well. Conversation about spring wheat harvest and finding and confirming those high yield expectations in a lot of areas north, up across the border into Canada. Also some better than feared type early results, it would seem. And regardless, just the pressure of harvest advancing and bringing bushels into the market, that was part of the trouble, it seems, today.
Let me run this by you. Wouldn't the wheat market be the one most affected by a potential Canadian rail strike?
It's going to be a heavily affected one, no doubt. Wheat in particular is not a huge export for U.S. to Canada, but wheat products is, and any food product for that matter, processed or even just refined 1 or 2 steps removed from the bushel of grain. So wheat will be likely impacted by this rail strike. They had targeted as soon as tomorrow for that to begin. Already those services shutting down in anticipation of the stoppage so that we don't have trains stuck. And again, this is in Canada, north of the border, these labor issues. It'll affect the wheat trade for sure. Also, ethanol exports being a top mover from the U.S. to Canada, a lot of the meat products. That's beyond what we also know are imports from Canada on the livestock front in particular. We've been lately tracking feeder cattle imports from Canada. If those shut off a little bit, that could influence the market. So many moving parts when you talk about relations with basically our number 2 trade partner.
Well, from what I remember, the Canadian railway system, I think they call it, is a CN, they call it up there. I think they have kind of a monopoly on hauling wheat to the West Coast. I think that's where almost all of it goes, isn't it?
Yeah, and so you'd think about the negativity of not shipping some from the U.S. into position Canada, but then also is there a positive where we compete more heavily because Canadian exports are shut off from those ports? Long term, there are those questions that right now we don't care to answer. It's just about the uncertainty about what's ahead and what follows the stoppage, how long it will last. That leads to speculators wanting to step out of the market or continue to press from the short side here.
On the other hand, maybe that would be a boon to U.S. companies like Burlington Northern, UP. They both have direct lines that go to the Pacific Northwest, right?
In the Pacific Northwest port, by all accounts, whatever product we're talking about has gained share here recently over the other big ports. The Gulf, of course, the largest for ag exports, but you see the Pacific Northwest is a huge player. And when we're talking about Canada and how they share and sort of compete access to that region, it's a big deal. We keep track of this.
I just wondered what that's going to do to wheat basis if that actually does go into effect with that strike.
Right. Logistics in general, we apply to the corn and soybeans now too, as we potentially look ahead towards a drier stretch, some lower river levels. We think about the last 2 years of coming into harvest with some troubles on low water. That after the growing season that we've had, flooding in some places, and then flip back towards these drier conditions that mess with logistics. And if not for, the strike and the labor nature of it, we here at home are always going to deal with the weather impact, just like everywhere else. But that can be something, if it persists, does spell trouble for basis overall.
Well, when we move over to the corn and soybeans, a lot of the talk in the trade this week, of course, is related to the Pro Farmer Crop Tour. It's an annual event, covers most of the Midwest, and I believe we have one more day to go on that yet. Early results coming out of there, what have you heard?
Mixed, maybe a bit light relative to what you'd expect if you looked at just the USDA figures. And wondering still, though, about the limitations of a tour like that. For as much information as we're glad to have from tours like that, other tours, our own tours, we know that they can sometimes be not expansive enough. And particularly if I can show a map, lately I've been monitoring this worsening situation of drought in southwestern regions, again, of the U.S. And so this ties back to the Pro Farmer Tour or others that might miss some of these worst affected areas of the Western Corn Belt, not just where it's white and unaffected by drought because of the excess moisture, of course, that areas have had, but in some of these yellow, tan, orange, red regions, these are areas that might not necessarily be touched by crop tours, and that even if they're not the most substantial or relatively more substantial component of the overall national yield averages, they can still be something that we would wonder if they take away from us being able to achieve these ultimately much higher national yield averages than we've ever seen before, right?
Well, and we do know that the corn harvest is well underway in the South. And I keep reminding people now where I'm located, I'm in what they call the Mid South. It would be in the Tennessee and Kentucky area. And gosh, the corn is drying down really fast here. I mean, it's just reached maturity. And I would imagine they'll be harvesting here probably within a couple of weeks, I would think.
Absolutely. Yeah, we have the reports from the state agencies like Texas, 60% harvested through this last weekend. Louisiana at 58% complete on corn. It is advancing in the South as it does this time of the year. And it'll be this focus on the opening of harvest elsewhere, and then the timing and the length of the harvest window and how much comes out and into the system at once that interplays with the price dynamics here as we go forward into harvest as usual. So that's something to generally watch out for. It'll be the first couple of weeks of September that we would start to have the national yield numbers out for the USDA on harvest progress.
Yeah, it's something to definitely keep an eye on, that's for sure. Let's talk about livestock here for a second. We had the cattle market trying to come back a little bit on the feeders. They've had some tough sledding here for a while. I had a podcast yesterday with Daryl Peel from Oklahoma State University, and he seemed to think that it's going to be hard to push that market down very far just because there's no way to pick up the supply anytime soon. I mean, he's looking like what, maybe a year or two out yet.
Yeah, and if you look a year or two out or on really any perspective further than a few days, then I think you can get back to the fundamentals and the expectation of convergence that the board will close its gap with the cash market. But that's what's occurred here in the immediate. You look right away and you can have these separations like we did where the futures fall first, and they fall a lot faster and harder than the cash trade because the cash trade is still fundamentally supported by those shorter supplies and the more solid demand still holding up into the late summer. All of that the market doesn't necessarily care about in terms of futures traders wanting to hit the exit and get out of a trade, whether it's because they're spooked by the headlines or what they're hearing politically or based on fears about the economy, or whether it just becomes that others had those fears, got out of the market, put price down below a certain target, and their computers say head for the exit. We have the livestock traders managed money crowds still with a hefty enough net long on live cattle in particular, and so that was linked still to shed on a day like today. They had already turned net short the feeders, so they were able to potentially hold up a little bit better for that reason. And then back to the cash side of it, you look at these feeder cattle contracts in the low to mid 230s, and we're talking about cash trade benchmarks around 250 or higher recently. So that's the rub of the two markets, futures and cash.
Now, if you look at October lean hogs, they did have a big outside up day today, the way it appeared, even though they closed lower on the day. I guess it would be an outside down day technically, but it did make a new high for the move, and it's actually kind of retesting the high that was made roughly about a month ago, isn't it?
Right. Anytime you see a bearish reversal, that would be a negative, but then you allude to the strength recently still putting us basically into the upper half of this last month or so and its corrective uptrend. The contract stopped short at support that looked solid at the 20-day moving average. You have yet a discount for now relative to the cash, which is important because that August contract has just expired, leaving now a pretty good premium for the cash over the October down in the mid just upper 70s. So all of that is an adjustment that could still continue to support this market while otherwise recognizing, like the cattle, if it's just an injection of risk off, that's what we got to watch out for. Like with anything.
So is that what it was late in the session that sold it off? Just a late flood of money on the sell side there?
It seemed to be more linked to that failed early upside attempt, and traders using that to liquidate some fresh speculative longs here. They stopped pressing from the short side as hard. They got a little bit bullish on the chart flip here, but now maybe running out of storylines and not having quite the same support we'd like from the cattle or other outside markets.
And the thing that drives me crazy, and everybody that has followed me for years knows that, um, when the Labor Department comes out and they say, "Oh, never mind, we were off on the jobs by 800 and some thousand jobs last year." Oh my gosh. I mean, talk about missing the mark. And I just wonder how much that took the wind out of the sails in the livestock trade.
Right. You reference these job revisions that now come back to the negative, and then have investors thinking, well, gosh, it turned for the worse. The economy did a lot sooner than we had thought it was. And for that reason, we're now way too late on responding to it. We're likely, possibly entering into a recession, which of course you don't know about until you get basically two quarters into it by the government's definition. And that means we're too late on monetary policy in the shift. And we're now worried about things breaking down and not being in front of the economy. Yet the stock market still rallies. It's coming off of, the best week in several years, a really solid turnaround from what looked like a shaky breakdown. So it's continuous. There continues to be this economic influence for sure.
Yeah, it definitely drives people crazy when they find out they've been trading bogus numbers basically for about a
Well, we
year.
say the same things for USDA and the grains, right?
Yeah.
And crop provisions, a September later or whatever. So, yeah, it's an unfortunate part of the market.
Yeah, if you and I gave out information that far off the mark, I mean, we'd probably have to answer for that, but not here. Joe, good to visit with you again. Thanks for all the information. And by the way, you actually contribute to these morning Comstock reports, don't you, on that newsletter?
I write the one on Sunday mornings to preview the week ahead. I'll fill in for the folks now and then on the morning updates, but I contribute as well on Fridays, some of the afternoon reports that go along with our subscription service. Try to help out as I can with that report. We're really proud of it, and all the advice we go through, the special features, the things we're doing with the Comstock channel. So yeah, I'd like to be a part of that.
Wow, I was always amazed when I first came on board. I would get the emails, and I wondered who is actually putting that out over the weekend. It's you.
Yeah,
So
with
anyway,
help certainly.
kudos on that. Joe Camp with us of Comstock Investments. That'll do it for this episode. For producer Brian Hendrickson, I'm Marlin Bohling. We'll catch you next time here on the Comstock channel. Thanks for joining us on our Comstock YouTube channel. Don't forget you can also find us on Facebook and TikTok as well. Futures trading involves risk. The risk of loss in trading futures and or options is substantial, and each investor and or trader must consider whether this is a suitable investment. Past performance is not indicative of future results.